And it's the top of the hour. Hello and welcome to our webinar today, 5 Big Myths That Are Killing Small Business in America and 90 Days to Consistent Cash Flow. My name is Scott Stroud. I'll be the host and moderator today. I'll be watching your questions and passing them on to our presenter, Jeff Prager. Your presentation today is a production of Cash Flow Engineering. What if you could create a system that delivered consistent, predictable, and sustainable cash flow for your business? Better yet, what if that system already existed? It was already built and all you had to do was essentially fill in the blanks to catapult your business forward. Well, that's what cash flow engineering is. That's what it does. The objective of cash flow engineering is this. In cash flow engineering, you view every dollar you spend as an investment. So if you paid out $1 and you knew absolutely that you'd get a return of $1.25 in return, wouldn't you continue to throw every dollar you had into that investment? Well, that's what cash flow engineering is designed to help us do. Our mission, we understand that running a business is a learned skill. Nobody was born knowing it. So our goal is to help business owners by teaching them to use simple tools that drive consistent, predictable, and sustainable cash flow in any economy. As a training and education company, our motto is business simplified and cash flow optimized. Our speaker today is my partner and the CEO and co-founder of Cashflow Engineering, Jeff Prager. Jeff has been a CEO, CFO, and CPA and owned numerous businesses himself. A very diverse business background and experience from Strauss Homes, which he and his partners grew from $0 to $26 million company. He was a founder of Gateway American Properties, again, from $0 to $150 million, and a founding partner in Ashworth Golf Clothing, which went from a startup to a public firm and is still in existence today. Jeff is the author of 3 books, The Peddler's Son, Financial Forecasting in Excel, and Managing Your Business with 7 Key Numbers. He's an adjunct professor at CU in Denver. Jeff, we are happy to have you as our presenter today. Take it away.
Thanks, Scott. Hey, today we're going to do this kind of informally, but we're going to cover the number one obligation of a business owner. We're going to talk a little bit about why businesses fail. I'm going to deal with the 5 myths of that are killing American businesses. But our objective today is to give you, again, tools to generate consistent, predictable, and sustainable cash flow in any market or economy. And by the way, all of you should have gotten a download so that you could follow along with me, fill in the blanks so that you have notes from this webinar in real time, so that, in other words, it won't be something that you're going to forget right away.
Yeah, and Jeff, if I can interrupt, for those that registered within the last 30 or 40 minutes in your control panel, which is you should see on the right side of your screen, the GoToWebinar control panel, there is a tab that says Handouts, and you can click there and download the worksheet. So if you haven't done so already, it'd be good to have that in front of you as Jeff goes through his presentation.
Because part of our objective is that when you go through our program, all you have to do is fill in the blanks, and that will make your lives a whole lot easier. So my first question is, what is the number one objective of a business owner? A lot of business owners get confused as to what they're doing, what their number one responsibility is. But what we found, that if the owner or the head of the organization drives consistent, predictable, and sustainable cash flow, they are guaranteed to have a successful business. So we know that small business is the backbone of America. And how do we define small business? Basically, if you're not one of the top 2,000 businesses in America, you're a small business. Anything under $1 billion is pretty much considered a small business today. The problem that we face is most of the business community is mired down with misinformation, misunderstanding, and misleading lies lies that cost us a lot of money. But what we found with all the businesses we worked with throughout our careers is that when you focus on the right numbers, the right activities, the right objectives, with the right systems in place, your business can succeed. That's a real important concept, is basically doing what you've always been told to do. Do it right. According to Forbes magazine, 80% of small businesses will fail in the first 5 years. Now, there's all kinds of statistics out there from the SBA on. It seems to be running around 80%, but in some cases, a lot of us might argue it's actually higher than that, and very few studies come out lower than that. But of the 80% that survive in 5 years, 80% of those will fail in years 6 through 10. So ultimately, only 4% of small businesses will make it through year 10. Why? Well, the number one reason companies fail is because they run out of cash. That's the actual given reason. But that's actually a symptom. And what I'd like to do is look at the underlying reasons why businesses run out of money. The first one, and matter of fact, the first three have to do with marketing. Number one, they're not in touch with their customers. Their customers don't know who they are and the value they bring to them. The second reason is no real market differentiation. There's a lack of a concise value proposition. And American business is based on market differentiation. How are we perceived as it relates to our customers and our competition? The third is failure to communicate what's in it for them. You've all heard, I think, of WIFM, what's in it for me. We're not telling the customers what the benefit is of working with each of us. Now we get into the real root of some of what I think are the major problems in companies. Number one is there's a leadership breakdown at the top. As companies grow, leadership, management, and execution become more complex and more difficult. And there's a consistent lack of planning or poor planning, poor capitalization. You do not have the money you need to grow. In fact, that's the reason why a lot of businesses that survive 2-3 years out go bankrupt, is they start growing faster than their assets will allow them to grow. A lack of business skills. And I know through my career, I started my life in a project in New Haven, Connecticut. And it was through learning business skills, which is different than what I learned in college. And as Scott told you, I'm an adjunct professor of economics over at CU Denver. But we don't teach business skills. We teach a lot of theoretical junk that gets in the way. A lack of financial education. Now, I'm going to make a huge difference between financial education and accounting. I'm not asking you as owners to understand debits and credits, but I am asking you to understand the story the numbers are telling you, which isn't that difficult to understand. The fifth reason is the inability to define a profitable business model, which includes a predictable income stream, predictable positive cash flow, predictable profitability. And one of the books I wrote was on financial forecasting, which is basically how to do it. But I've always learned real early in my career that it's not rocket science to come up with these projections. All you're doing is putting on a piece of paper the cash coming in and the cash going out. So it's not enough just to survive if you own a business. The real question is, what must you do to prosper and thrive? There are several choices, but we found the best method is to learn and use the fundamentals of cash flow engineering. And by the way, that is our registered trademark, and it's the road to superior performance. So let's start dealing with the myths. Myth one, it's all about making a profit. Truth is, it's not about profit, it's about cash flow. To succeed, first you must manage cash flow, because without cash you can't survive in the short term. So not only the short term, but the intermediate term and the long term. We want to think in all three categories: short term, intermediate term, long term. Then secondly, you manage the profits, because without profits, you can't survive in the long term. Now, let me go through the difference between cash flow and profits. Cash flow is what's in the bank and what's coming in the bank. Now think about Amazon. Amazon went 6 years before they made a profit. The question is, how can you go 6 years without making a profit? So profits is an accounting concept. It is actually fiction in a lot of cases. Okay? Think about who's driving generally accepted accounting principles and the way you account. It's basically the IRS telling you they want to see as much profit as they can so they could tax you as much as they can. So there's a huge difference between cash flow and profit. One more way of looking at it is, how many of you look at your profits at the end of the year and say, well, where's the cash? And finally, to succeed, a business must build value and consistency in their ability to generate and keep cash. So one of the things I learned very, very early in my career is what I've called the bucket theory. Now, I want you to think as a business owner. As a business owner, you think about cash coming in and cash going out. Cash comes in from the sale of your products, from debt, or contributions to your company that you make or your investors make, or equity contributions. It goes out for cost of goods sold, overhead, salaries, to purchase assets, and to pay dividends or pay back debt. Unless the money coming in is greater than the money going out, there's nothing left for you. Okay? Now let me tell you the difference between accounting and the way we business owners think. There's this dotted line right here that you could see. To the left of this, you have some cash inflows, some cash outflows, and these show up on your income statement. On the right, you have some cash inflows and some cash outflows, and these show up on your balance sheet. So if you're managing to one of these two sheets, you might be leaving a lot of money on the table or not understanding where your money is going to come from and the traps and obstacles that you may be facing if you start thinking like an accountant. And you'll find out, I am a CPA, I'm a retired CPA, but you'll find out that I will contend that a lot of what the CPAs are telling you is just plain bad advice. So there are only three things that count for you as a business owner: cash in, cash out, and the balance, your cash balance. Profit is a long-term result, but only if cash flow is your short-term obsession. The second myth I want to dispel is take it one day at a time. I found that the truth of running a business is start with the end in mind and work backwards. Okay? Again, start with the end in mind. Where do you want to end up? Look at where your profits are going to be, where your cash is going to be. What would you like to look like in 5 years versus where you are right now? Because what you're trying to do is bridge that gap between where you are and where you want to be. Let me drive this home a little. Let's say you're a carpenter. Let's say you want to build a business that you could sell for 5 years, in 5 years for $5 million. So you're building a business, you want to sell it for $5 million, you've got 5 years to do it. Well, what you do is you break it down into the components. What do I want to have by year 4, by year 3, by year 2, by year 1, by quarter 4, by quarter 3, by quarter 2, by quarter 1, by week 1, week 2, and you work your way all the way backwards. And if you start making decisions based on where you want to be versus where you are today, you'll find that you'll run a better business immediately. And that's one of the things we like to do with people is get them focused on where do you want to go? Because you're making decisions all the time. Where do you eat lunch? Who are you taking out for lunch? Where are you renting your office space from? Every one of those decisions will ultimately affect where you're going to end up. The other thing that goes with start with the end in mind is the difference between Main Street accounting and Wall Street accounting. On Main Street, the way we're taught in small business and in schools everywhere is sales less cost equal profit. What that means is that whatever's left over is what's for you. And it's a horrible way to run a business. Now think about Main Street. Think about what happened in 2007. How much of Wall Street companies lost money when all of us were. And that's because they have a different formula. They have sales less profit. So the first check they write when they get receipts is to their bottom line. And then they say whatever's left is what we have available to fund our growth, fund our costs, fund everything. So think about like how Hewlett-Packard could lay off 5,000 people in one day. And you start realizing that it's not the people that are important to them, which is not a philosophy I have, by the way, but it's profit. If you start monitoring, and I'll show you how to do this in one of the other myths, I'll show you exactly how to do this. But if you start working for profit first, it will change the way you run your business. Here's an example. I'm going to go through history. In 2015, I made $400,000, and this is a worksheet that we give to people in some of our programs. We want to keep it simple. You made $400,000, and look at your net income before taxes, $2,000. Now, you go back and you look at 2016, and you say, okay, what did I spend my money on? And then you look at your percentages, and you say, rather than do it the way I did, suppose sales are 100%, that's where you start with. The next number you put in is the 5%, and the 5% represents what I want on my sales. I know my cost of goods sold, and then I start plugging numbers in, and then I realize that this is what my projection is going to be. I put in the $800,000 of my goal for next year, and it tells me that I got $600,000 for cost of goods sold, $100,000 for salaries, $24,000 for sales and marketing, and $36,000 for other expenses. And that's what I need to manage to. Then I can look at, okay, here's the numbers I just said I'm going to manage to. But over the projections, I could put in where I want to grow. I could put in a new percentage of where I want to end up and work backwards to say, okay, between years 2017 and 2018, I'm going to find a 1% change in my cost of goods sold. Okay? And that will increase my profit margin. Now here we're starting with, okay, here's how we start with goals and strategies, is figuring out where we want to be and giving us the time to get there. One other fact is that everybody thinks that you hire a consultant, you hire a coach, and boom, like a magic bullet, everything's going to change. Let me tell you the real reality of running a business. There's not a magic bullet. There isn't. There's a lot of little things you do that when combined, when aggregated together, that's what gets you your long-term results. So it's not one little thing, and I want you to really get this, is it's not one thing, it's an aggregate of many little things watching your business that will get you to your end game. We go through this a lot in our 90-day cash flow. And again, a challenge, which is a program I'll talk to you about a little later in the webinar. But we go through a step-by-step process on how you can manage your numbers better so that you, within 90 days, most businesses that take this challenge are going toward or have already accomplished positive cash flow. And then we're going to roll that within this 90 days into the bigger picture of where do you want to be this year, and then we roll that into your 5-year plan. It's real simple. And if you don't know how to do it, all you do is just take our numbers, because we're going to give you a sample. Again, our theme is we're going to give you something so you can fill in the blanks, but you just redo our example until you understand how it applies to your business. And then one last thing, we're there to help you. Myth 3, only big companies have systems. Okay? The truth is, every successful company, big or small, needs a system. Take McDonald's. When Ray Kroc bought it from the McDonald's brothers, he saw a system, and he said, hey, let's franchise this. But they have gone down to every little aspect of their business. And I don't know how many of you are as old as I am, probably very few of you, but when I started going to McDonald's, a hamburger was 15 cents and French fries were a dime. Okay? They'd have a sign on the arch how many millions of hamburgers they sold. And we as consumers would watch it. And then they finally got to the billions. But they didn't start overnight. They started with systems. Now let me ask you, what's the definition of insanity? This is an old Albert Einstein joke. Insanity is doing the same thing you did today, doing the same thing today that you did yesterday, and expecting different results. That's the definition of insanity. The definition of a system is doing the same thing you did yesterday and expecting the same results. In other words, if something is working, continue doing it. If something is broken, stop. I have a couple of core principles that I've used throughout my career. A problem's a problem until you reduce it to a procedure. And what that means is, do you have a system for developing leads? What about a system for closing sales? What about a system to produce your goods and services? And what about a system to manage your business? Now, it sounds daunting, but one of my principles is keep it simple. The second principle is running a business is a learned skill. I did not learn what I needed to do to run my businesses overnight. I was taught. I had mentors. I wish I had programs like what we're going to offer to you. But you have to learn, improve, and practice everything you're doing if you want to succeed. You need to be able to quickly identify missing pieces, broken parts, or disconnected systems. Think about a car. A car is a bunch of systems. And if any part is broken, missing, or disconnected, the car doesn't run efficiently. And think about how to apply that to your business. How do you make your business run efficiently? And basically, the parts that are needed to run your business are marketing and sales, operations and organizations, and financial management. And again, I want to make a big difference. Financial management is not accounting. There's a huge difference. You don't need to be an accountant to understand how to manage your business by the numbers. My third core principle is never start with a blank piece of paper. Even in this webinar, we gave you a fill-in-the-blank piece of paper so that you can remember what we're talking about and use it as a resource as you go forward. So our third principle is never ever start with a blank piece of paper. You're reinventing the wheel. And one of our core principles is never reinvent the wheel. The fourth myth is I could do it myself. Well, the reality of it is success comes from building a team of specialists. Now, one of my companies was a home building company. Another one was a golf clothing company. I got to be honest with you. I don't play golf, and I don't know how to build a home. But I know everything there needs to be in order for that house to be built. And I run my businesses based on knowing my systems and monitoring my systems and making sure all the jobs pertinent to getting that house built are done correctly. You need to find people who can execute. Let me give you another example. Suppose you're a carpenter and you open up your own business. Okay? So the first day you're working and you've got your nice new office, your nice new desk, and you're drinking out of your cup of coffee and the cup says, boss. Okay? You're sitting there, and what do you hear? Nothing. You hear the drone of the air conditioner. So you need to do something to start getting work. So all of a sudden you decide, oh, I'm going to get on the phone. Well, you're no longer a carpenter, you're a salesperson. Then you get a lead, and now you've got to close the sale by creating an estimate, by having a contract. So now you're a lawyer, you're an estimator, and you're still not doing carpentry. And then you sign the contract, and now you got to be a purchasing agent. You got to get your subs in place. You got to get the materials in place. There are lots of jobs to do. And so you, the business owner, are no longer doing what you excel at, which is, framing or carpentry. You're doing everything else related to running that business. And so you need to get people to help you because you can't be an expert at everything. In fact, when I ran my businesses, I literally was the guy in this cartoon. I'd sit there and I'd look at my numbers, and I'm going to show you the 7 numbers in a few minutes. I'd drive my cash flow. When I was at my peak, this is back in 2005, 2004, I was either an owner and or managing over 156 companies at once. And this is no lie. I was managing 156 companies. All right? A lot of them were multi-million-dollar companies. Strauss Homes, we were at 26 million. My Gateway American Properties, we were doing over 100 million a year in lot sales and land development. And this is me. Not only did I do this, but I did it in less than 10 hours a week. And I was teaching at the University of Colorado, and I was still working less than 40 hours a week. If things are working, if you got the right people, if you have the right systems, all you're doing is monitoring those systems. So we talk about this in our management course, which is your success depends on your ability to lead, manage, and execute. And again, these are all recipes, formulas that seem to work in every business I've ever been in. So leadership is outlining a clear, compelling vision and standards of accountability within your organization. Management is creating an environment of success. Get your managers, get the people around you all geared toward the same goals, which is what the leader is supposed to do. And execution is doing those things that get you to the right vision, to make your vision happen. We have 3 fundamentals of leadership. Have a vision. Know quantitatively, not qualitatively. It's not good enough to say, I want to be the best in my business. That has no meaning. But a leader must know quantitatively where their company is today and where they're going to take their company tomorrow. Once you have a vision, you start outlining the overall objectives or goals or numbers that you need to meet, and the strategies or the how are we going to get there? And then the final one is you need to drive performance through the organization. And you do that through your management team, whether they work with you, they're your consultants, or whatever. Their job is to assess where they are. Think about a sales department, a marketing department, a production department, an HR department. It goes on and on. But they need to know where they are and how they fit into the bigger picture and how they're going to get you where you want to go. They need the ability to generate their expectations or objectives, in other words, sub-goals and objectives, so that they could get their direct reports on the same wavelength. Then they need to develop the strategies or the projects to accomplish those objectives And the final thing your management team needs to do is select competent people or resources to fill those vacancies and get the job done. Now, in terms of execution, we need to communicate the goals and overall strategy for execution to not only the managers, but all the way through your organization. You need to outline, literally spell out the steps for execution, say who's going to do it, what's going to be done, what's the due date, and how are they doing. And then you need to have a feedback system or a follow-up mechanism so that you can know immediately whether you're progressing toward your goal or you're going to miss your deadlines, which is unacceptable behavior. This is all easy to do. I'm serious. In a lot of companies, we could do it even on the back of a napkin, and you're going to find out that simplicity is a key to everything I do. We talk about this, and we go through this in the Cash Flow Mastery program. And we have, if you go to our website, we have 2 different programs related to cash flow mastery, which is a step-by-step procedure on how you could follow our recipe to run your businesses better.
Hey, Jeff.
Yeah.
Well, we're halfway through the program right now, and I just wanted to give people an opportunity to ask questions. And just to point out, which I failed to do at the beginning, that in your control panel there on the right side of your screen, there is a questions tab. So if you've got questions, I'm watching that, and if you want to ask, just type in your question. I'll respond to that, or we'll interrupt Jeff and get an answer to you, back to you before the end of it. So I just wanted to make that mention. Please continue.
Okay. Thanks, Scott. I'm glad you pointed that out. Myth 5. You need to be a CPA or a mathematician to understand the story behind your numbers. The truth is, all you need is 3rd grade math. Now, I told you I taught at the University of Colorado. I taught economics, and I taught at the graduate level, and it was called managerial economics. And what we did is we blended economic theory with the theory of running a firm. And because it was a master's levels course, we had to use tools called econometrics, which is a blend of calculus and statistics. Now, before you all hang up on me, here's the key. I have never used it in my whole career other than in teaching. So when I'm done, I go, okay, now you got your answer using econometrics. Now let's do it with 3rd grade math. In fact, the problem is simply a division problem. And now apply your common sense to my 3rd grade math. And we did it literally on a scratch piece of paper. And I'd ask my students, which is the better answer? And unequivocally, it was the one we did on the scratch piece of paper. Now, we're not United Airlines, and we don't have all these fancy computers and algorithms to run our business. But the fact of the matter is, the most sophisticated mathematics is not really done in the small business arena. We use simple 3rd grade math, and I've not found an exception. And I have worked with billion-dollar companies, and I haven't found an exception to it. Okay? All you need is 3rd grade math. Here's something your accountant or CPA won't tell you, and I'm going to show you an example. But a number in and of itself has no value. All right? Remember that. A number in and of itself has no value. All right? When you're working with numbers, this is the biggest lesson I could give you. You need a benchmark, a number to compare your results to. And managing your organization is nothing more complicated than comparing two numbers. Again, all you need is 3rd grade math: addition, subtraction, multiplication, and division. And you don't really need to do that if you have a calculator. Matter of fact, I don't know how many of you know what CPA stands for, but my definition is can't possibly add. Because if you took away our calculators, we can't do our jobs, okay? But it is 3rd grade math, and you have a calculator too. And the ability to point your thumbs up and thumbs down. And this is how I managed 156 companies at once. Okay, let me give you an example, and I'm going to turn you all into CPAs in the next 30 to 45 seconds. Here it is. I made $50,000 this year. That's after my salary, everything. My business made an additional $50,000. Is that good or bad? And hopefully you in the audience, what you're doing is you're pointing your thumbs. Well, the right answer is I don't know. Because remember, a number in and of itself has no value. Now, if my goal was to make 10,000 this year after paying myself and I made 50, would you point your thumbs up or down? Hopefully all of you have a big smile on your face because this is easy, right? You're pointing your thumbs up. But if my goal was to make $1 million this year, $1 million, and I only made 50, which way would I point my thumbs? Down. When you're pointing your thumbs down, that's when you need management activity. Okay? I hope that makes sense to everybody. So what I want to show you is how to manage by the numbers, but it's not just numbers. You need the right numbers. And I'm going to do it as simply as I can. And I found this works with any size company. And if you're a multi-divisional company, you'll do it by division. Multi-products, you'll do it by products. If you're a holding company with multiple companies, you'll do it by each company, by each division, by each product. But it's the same 7 numbers. These are what they are. The first one is your number of leads, because you want to measure your marketing effectiveness. You want to know how many leads you're generating. The second one is it's not good enough to get leads. You want to get a return on your marketing dollar. How many of those are you converting to sales? The third thing is how many of your customers do you keep coming back? Now, if you're in the home building business like I was, you would say they only buy once. Well, we started measuring how many referrals we got, and we also started looking at the demographics of our audience and of our purchasers. And what we found is that if they had a certain demographic, we would go there at the end of 3 years if they were still living in a Strauss home, and we'd say, hey, we noticed you've been living here for 3 years. Thanks for living in our community. We'd bring a bouquet of flowers, and then we'd start talking to them and about their family size and what they did when they bought the house versus where they are now. And we'd get 3 or 4 sales a year just based on going back to those customers, selling them to a bigger house. That's 3 or 4 customers a year that I didn't have to pay realtor commissions and exorbitant sales fees. And they knew my product, so the whole process of sales was a whole lot easier. How many transactions per customer? For driving cash flow, repeat business, or upsells, depending on your business, this could be interpreted a bunch of different ways. But how many transactions per customer and the average price per transaction? Now, again, I told you I'm a CPA. How many of these numbers are numbers your CPA deals with? These drive revenue. What your CPA usually talks about is controlling cost and your fixed cost. Now, let me ask you a question. If you're budgeting your fixed cost, what's the number one largest expenditure most businesses have? I think most of you would agree it's payroll. Now, when you're talking about payroll, who should be the first name on the list of people to be paid? And I hope you say yourself, because you should budget your salaries in your fixed costs. Otherwise, you don't have a profitable business model. Okay? Now, how many of you, your accountant is telling you to cut your cost? The number one line item on your cost is you. How many of you really want to cut your cost? The key to cost containment is driving efficiency and keeping your cost related to the number of transactions you have. Take some of the bigger restaurant chains. The accountants Papa John's is a great example. The bean counter said, let's cut the quality of the ingredients. Let's keep making a smaller pie, whatever. And all of a sudden, one day, Papa John wakes up and finds out that people are writing all over the internet that his pizzas taste like junk. And so he literally starts a campaign and says, I heard you. And they started improving their ingredients again. And they started making a better product and rejuvenating the company. Cutting costs for the sake of cutting costs, what the bean counters are telling you to do, are not necessarily good. One other example is Home Depot. When they first opened, there was somebody, a specialist in every aisle. Now go into their warehouses and try and find somebody to help you. It doesn't work. my question to you is, will tomorrow be any different than today? Use these 7 numbers, and they're going to help you predict the future, and they help you change your future, and they help you direct your business as to where to go. So I've got to do this rather quickly, but I'm going to introduce Vandelay Remodeling. And this is a real live client, but the numbers I'm using, I use simpler numbers. But he came to me during 2007, 2008. He was a basement remodeler. And he did a good job and had a nice business, had a couple of people working for him, an administrator. His wife, Susan, did the books. And they had a nice little business. But then, in order to survive the recession, they started doing handyman work. So I started with the end in mind. I said, hey, Art, and by the way, you should think about who Art Vandelay of Vandelay Remodeling is. Think about Seinfeld, and I hope it brings a little smile to your face. Think about George Costanza. All right? So my goal was, my first question is, what do you want as a cash goal? This is after paying yourself, because don't forget, as a business owner, you have a lot of sweat equity. And my definition of sweat equity is waking up at 3 o'clock in the morning in a cold sweat, wondering how you're going to get through tomorrow's payroll. So he said $30,000. His fixed costs were $120,000. And again, I want to reiterate that includes his salary. His variable costs are 75%. So mathematically, just by division, if we take 120 and divide it by 25%, I'm not going to go into the mathematics. You don't have to understand it because I could give you a spreadsheet that does it for you. You have a revenue goal of $600,000. But the question really is, how are you going to get there? Well, we found out that the average price per transaction, or what Art said, was $600, meaning he needed 1,000 transactions a year. Think about that. There are 250 working days a year. That's 4 sales a day. That's a lot. Then the number of transactions per customer were 4. He went from basement remodeling to handyman work. He had a certain base of customers, not a lot because he didn't do a lot of basements. And that leaves him 50 customers that are working with him. That means he needs, if you take 1,000 divided by 4, and again, all this is done in a spreadsheet. Don't worry about the math. You need 250 customers. You have 50. You need, so you need 200 more customers. His closing ratio was 25%. What happened at Vandelay, whoever picked up the phone was the salesperson. That meant he had to generate 800 leads a year. What we do is now we're going to manage by the numbers. We were proactive in the first iteration. We were figuring out where we wanted to be. We started with the end in mind. Now we turn it upside down and think like a business owner. How many leads do you need to generate? What's my conversion rate? So all this schedule is doing is turning your numbers upside down. Now remember I said a number has no value unless you compare it to another number. So we actually looked and we said, oh my God, what are you doing? And we found out that he had actually 500 leads instead of the 800 he needed. Now there's a technical term. First of all, are you thumbs up or thumbs down? You wanted 800 leads, you got 500. Your thumb should be pointing down. And there's a technical term for where you're missing your goal. It's called uh-oh, because there's a cascade effect. If you start using the 7-number situation or our system, you'll find out there's a cascade effect of every number. And what we do is we look at it and we say, oh my gosh, not only is he missing it here, but his average price per transaction is $500. And his trajectory is to get $350,000 instead of $600,000 in gross revenue. And what Art didn't realize is, as he's doing this handyman work and he's doing a lot of smaller jobs, his cost of goods sold is going from 75% to 80%. His fixed costs don't change. What do you think is going to happen to his bottom line? It's going to be negative $50,000. Where's that 50 coming from? From his pocket, his savings, or he's not paying his vendors? And the reality of the situation is Most businesses that go out of business through bankruptcy. I don't want anybody who's working with us to have that kind of fate. So we started looking at the key things that were going wrong. And we started asking ourselves the question, what if we could change our conversion rate from 25% to 35%? We had no money to invest in marketing because we're losing money. And what if we could increase the average price per transaction from $500 to $750? And we generate change through what I call the 8 Ps. What's your purpose? And whenever I analyze a business, and I used to teach CPAs all over the country how to do business planning, but I found that there were really 8 ways that I could analyze any business. What's your purpose? What's your vision, your mission, your values, your core values? What's your product? What are you selling? What are the features, the benefit, your market, your industry, your competition? Where are you selling your products? Is it through the internet? Is it through brick and mortar? How are you promoting your product? Through advertising, PR, marketing, and what's your sales process? How do you price? Which is a huge thing I find out is major. A lot of people do not know how to price their products correctly. What are your incentives? What are your terms? What are your guarantees? What are your warranties? Production. How do you produce your product or service? How do you deliver it? How do you fulfill it? And how do you keep your promise to your customer that you made during the sales process? People. Who are your employees? What's the management like? What's your culture like? How are you organized? And then again, profit, which is fiscal and financial management. And what we do is we have a matrix and we say, what numbers don't we like? And again, your 3 key areas, sales and marketing, operations, and management and finance. And we look at our 8 Ps and they fall neatly into our 3 major categories. And we say, what are we going to look at to change where you're going? This is strategic planning in a nutshell. And I've never saw this taught anywhere. This is something that's taken me 45 years to figure out. So we go in and we say, what levers are we going to change? What are we going to pull? Okay, and that's the 8 Ps. So we're going to look at promotion. And we looked at increasing the conversion rate. What we found was Art was a heck of a salesperson. So what we wanted him to do was handle all the sales, but not all the leads. So we created a customer qualifying sheet that asked our clients, his clients, what they wanted, how urgent was it, how much were they thinking of spending, what did they need to do, and we started focusing Art on the bigger jobs, the better jobs, and then what we did is we trained people in proper phone technique. Sounds pretty simple when you think about it. Then we looked at the price. And we said, we're going to increase our average price by sending the smaller jobs to our competitors. Let them go out of business. We're going to use better time management, better qualifying, and better systems. This is what we could do in the short term. And when we look at helping people, we look at the short term, the intermediate term, and the long term. As an accountant, what we were taught is to look only 1 year out. Actually till your next fiscal year end. That was a concept called going concern. Your CPA is only trying to make sure that you're going to make it to the next tax return. That's not how you run a business. So we changed our conversion rate and our average price. And again, this is a spreadsheet. It's a very, very simple spreadsheet that we use to manage businesses. And what we did is we changed the path of the company so that now they're going to make $15,000. Again, look at what happened. It's a $65,000 swing. Art's paying himself because he's part of that 120. We now have $15,000 to either pay ourselves more, invest in marketing and sales, or grow our business. Now with that $15,000, we could focus on generating more leads. We could focus on operational efficiency, but we bought ourselves wiggle room. And remember, I said there's no magic bullet. There's a lot of things going on at the same time. But if you're creating and monitoring benchmarks over time, that's going to lead to the cash flow you need to grow your business and increase the value of your business. So I want to ask you a question. Is this you? Are you overworked, underpaid, worried about payroll and cash flow? Are there not enough hours in the day? Because when the bottom line is, we only have time, energy, and money. And the real question is, do long hours and hard work equate to success? I have a saying, and I really mean this. The harder I work, the less money I make. I make money when I'm thinking strategically about the direction of my company. In fact, I have a sign in my office that says, if I have anything to do, it means I'm understaffed. Here's the problem with hard work. You have no time to work smarter or enjoy the benefits of owning your business. And that's what we're trying to do with cash flow engineering, is give you the flexibility to have your business work for you. Imagine life where you're in complete control of your business, where you're generating consistent and predictable cash flow, growth, and value, where you have more time, energy, and freedom. Start equating this to what this means to you, where you could reap the rewards of ownership. Ask yourself, why did you go into business in the first place, and are you living the dream? Steer your business to avoid obstacles. Take advantage of opportunities. You want to be able to make sure you always have cash flow. You're always able to pay yourself and your employees more. I've always prided myself in my companies that I have the highest paid employees in the industry I was in. I want to meet my obligations, and I want to be able to invest in growth opportunities. So here are my rules in a nutshell. Start with the end in mind. Know where you're going and make your decisions based on where you want to go, not on your checkbook today. Number 2, don't reinvent the wheel. Don't reinvent the wheel. Don't reinvent the wheel. There's always somebody who knows or has gone through what we're going through and can get you to the end game faster. Yet what do most of us do? We reinvent the wheel. My third rule is, if you take care of your business will take care of you. Drive your business so that it at least pays you the salary you would make if you were to work in the workforce. Then drive your business so it pays you dividends and distributions, and then drive the value of your business so that ultimately you could get rid of it and have a nice nest egg to carry you through retirement. My fourth rule is, a problem's a problem until you reduce it to a procedure. How can you make running your business more like a car, make it more of a system instead of working everything over and over every single day? It's time to get off the treadmill. Again, our mission is to teach you the skill of running a business. And we do that through simple fill-in-the-blank, simple answer tools that will help you get where you want to go faster. Simplify your business, optimize your cash flow. So now what? The 7 key numbers can help you drive this cash flow, but only if you put them to work. Like Scott and I were talking about this while I was on the way to work this morning, and I said, Scott, we are not consultants and we're not coaches. We want you to help yourself. And we're here to help you when you can't complete a task or figure out how to get to the next step. But our goal is not to be a wedge in your wallet. Our goal is to give you these tools so that you can make outstanding returns on your money. Think about our definition of cash flow engineering. You invest $1, you get $1.25 back. So the first thing we'd like to do is challenge you to improve your cash flow over the next 90 days and implement what we've taught you. You have to decide which path you want to take. The trial and error path, which is pull out your hair and hope, or the simple step-by-step method where we give you a recipe so that you can improve your performance and conquer your cash flow. If you're ready to take the next step and commit yourself, we'd like to invite you to take this challenge. So here's what it includes. We're going to start with, very quickly, 4 workshops that are going to cover the whole 90-day process. And it's a 13-week, 90 days is 13 weeks cash flow. We're going to give you a template so that you could budget better, you could monitor your cash better, and we're going to walk you through the steps of doing it. And then along with that, we're going to give you tips so that you could generate more cash flow today. I believe in the first 4 seminars that we're going to give you, there's over 200 tips to improve your cash flow. We're also going to talk about pricing your products to make money. Again, we're going to give you the Excel spreadsheets, and we have some other bonuses for you if you decide to sign up. We're going to also schedule open forums where you could, with me and Scott, with us, discuss the challenges you're having with your businesses, and we're going to try and give you real answers that will change the path of your business so that you're generating positive cash flow. Again, we want you to be able to visualize your results. We want you to see what it's like to start with the end in mind. This isn't a theory. It really works. And we want to help you implement the Wall Street versus Main Street strategy of running your business. And we guarantee you're going to have if you follow the program, you will have measurable improvements in your cash flow within 90 days. We've seen it as early as one lesson. People start generating positive cash flow. And as a bonus, we'll give you a book. I forgot, but I think it's 58 pages, but it goes through the 7 numbers in great detail. It shows you all the little steps in what I showed you on this webinar. And if you buy any of our other programs in the next 12 months, we'll give you 20% off the purchase price. Oh, and we know that you can't remember anything we teach you. So we're going to record all this so that you have access to the recordings through the 90 days so that you don't have to memorize and grab everything. Because I know a lot of people sit through seminars and they have all these notes and haven't got a clue what they're saying. And again, the group sessions. So what's the investment? Well, because you don't have to fly, drive, or take a train to get to us, you save that money, and we have a set schedule. The investment is $498 for the full program. That's the full program, all 90 days. But if you sign up in the next 48 hours, we're going to give you a $200 discount and sell it to you for $298. It's a heck of a bargain, and if you don't see a return of $1.25 on this, you really aren't following our process. This is really a simple method. So again, we're going to give you live webinars, questions and answers, unlimited access to the recordings, and group sessions. This is where you can enroll at cashflowengineering.com/90days/. Scott, I'm going to also turn it over to questions if anybody has questions, right?
We do have some questions coming in, Jeff, and thank you. Excellent presentation. And just to reinforce what Jeff has offered, the 90-day cash flow challenge, we started this back in December, and we have a group that's going through this now. So we've already got the first group of people in this. But please go ahead and sign up for this. And for the next 13 weeks, we'll work together. Here's a couple of questions that we have. Bonnie asked this question, Jeff. How can you use this information in a nonprofit?
Oh, it's very funny that you should ask that, Bonnie. We actually did a program for United Way here in Denver, and they got all the local nonprofits together, and we took the 7 numbers and we applied it to a nonprofit situation. So it works. It absolutely works. And you've got to think about it is that you really are, in order for you to fulfill your mission, you've got to have positive cash flow. It's really that simple. And we did a few seminars, live seminars here in Denver, and we applied it to a nonprofit. It absolutely works. The principles are identical. The terminology is a little different. But that's one of the things we do is if your terminology in your industry is a little different than our terminology, this will work. All we have to do is adapt it. And by the way, can I do one more call out? I understand Alan from across the big pond is on this today. So I want to welcome you, Alan. I know we've worked together in the past, and it's a thrill to see you here today.
Alan is from Wales. Alan Lewis, an old friend from Wales, is on the call today too. Yes, as are some other friends of mine. Joe Foker is on the line, and Joe and I go way, way back about 20 years. Bryant McNeil, both from the log home industry. A couple that we've had some good relation. Manny Schatz, my friend from California, is on the line. Welcome, Manny. Scott Lippett, one of our faculty members, is on the call with us too. So just
and
a few
I
of
think
you.
Scott Barth and Ty, you guys are on. We appreciate it. So, any other questions, Scott? Because we're running out of time.
They're going, hey, what about a money back guarantee? What if we're not happy? And the truth of the matter is, in the first 30 days, if you're not happy, you take it and you're in the program for the first 30 days and you don't see any benefit to you. You start to get the product, the programs that we have there that we've gotten you so far. If you're not happy, we'll give you your money back. We want satisfied, happy customers. We want people that are and our clients and our students engaged with us. And if you're not engaged and you're not using it, then you don't feel like it's of value, then we don't want your money. We'll give it back to you no matter what. So just let us know, and you'll get that refund in the first 30 days. So we're all set, and we look forward to having you all join us there. This will be an enjoyable time, as well as something that we know will add value to your business and your bottom line.
Thank you all.
Yeah, thank you. Bye.